Thanks, Matt, and good morning, everyone. My name is Sasha Franger, and I'm the Fiduciary Research Analyst here at Lipper, and basically that means that I look mostly at expenses, and that's what we're going to be looking at here today. We're going to be looking at our recent publication called the Lipper Quick Guide to Fund Expenses. Just real quickly here, nothing surprising on the agenda. I'm just going to introduce you to the table. We'll talk about some of the findings, and then we'll talk just briefly about what we expect expenses to do possibly going into the future here. Now, I know this is very hard to read. I just wanted to give you an overview, a picture of what the entire table looks like before we start zooming in on certain sections. The table can be found at the link I have displayed here to the right. And what we have included in this table are all the expenses for mutual funds with fiscal year ends in 2011 with at least 6 months of data. Now, this might seem kind of like old news because we have Tom, Jeff, and Matt in here talking about Q2 already. And why are we talking about 2011 expenses? Well, where we get this data from is from the annual reports, and if we include 12/31 of 2011 in here, it's a couple of months for those annual reports to come out, and then it takes our data department a couple of months to process those, and then I have to put the table together. So really, this is very new news from an expense perspective. In this table, what we do is we display the simple average along with the asset weighted average, and just to give an idea of what the difference is. So if we move on to some of our findings, there are really two findings that we have that apply to all groups that we see in this table. And the first is that the asset weighted average is less than the simple average. And you can see this by the numbers that I have circled here with the red circle. Typically, as a fund grows in size, their total expense ratio decreases because they realize operational efficiencies. In other words, they benefit from economies of scale. So that's what causes this asset weighted average to be lower than the simple average. And we see this again not only in this year's table, but we've seen this in previous year's tables, and we expect this finding to exist in future years. A second finding that we see across all groups is that institutional funds typically have lower expenses compared to front-end and no-load funds, and front-end and no-load funds have lower expenses in comparison to back-end and level-load funds. And this pattern is partly attributed can be attributed to 12B1 and non-12B1 fees. Institutional funds usually have the lowest 12B1 and non-12B1 fees, whereas front-end and no-load typically have the middle ones, and then back-end and level load typically have the highest 12B1 and non-12B1 fees. So now we're going to dive in a little deeper and look at individual groups. This slide shows what we see happening with index funds and ETFs. And as expected, we can see that index funds and ETFs have lower average and the asset weighted average total expenses than actively managed funds. And as I said, we expect this finding, and that's because index funds and ETFs cost a little less money to run. They are tracking an index, so there's not as much research that's involved. The next group we're going to look at individually is funds of funds. And funds of funds are an interesting case. It's difficult to compare their total expense ratios to non-fund of funds because they include an extra expense component called the underlying fund expenses. And these are expenses that they get from investing in the underlying funds. Now, while they have this extra component, we can say that the mixed asset non-fund of funds and the mixed asset fund of funds do have similar average total expenses, even though they have this different expense component. And this may be because despite their different expense components, they still contain a similar mix of equity and fixed income investments. Now, taking a step back, we're going to look at actively managed funds. We can see here in the red circles that as expected, equity funds their asset weighted average is almost double that of the fixed income funds. And then what I have circled here in blue is the money market funds. And I circled that and I wanted to highlight these because they seem to break all the rules. Their asset weighted average is not always lower. The front end and no load funds are not less expensive than the back end and level load ones. And so I wanted to highlight this, and I think the reason we're seeing this happen, especially with money market funds, is that they're having to waive all kinds of expenses, management expenses, non-management expenses, and even 12B1 fees to maintain positive yields. And we actually saw this happen for the 2010 fiscal year ends as well, but it's even more exaggerated here in 2011. So that kind of wraps up what, some of the main findings. I wanted to talk a little bit about future expectations. And the way that I'm going to talk about future expectations is to first talk about what did we see with expenses from 2010 to 2011. Well, overall, from 2010 to 2011, we saw a decrease of 3.4 basis points for average total expenses. For equity funds specifically, we saw a decrease of 3.9 basis points. And for fixed income funds, we saw a decrease of 3.1 basis points. So again, they're all in the 3 to 4 basis point range. I think going into the future, I think we're going to see a more downward trend as the economy improves and assets in mutual funds increase. I also think, and this goes back a little bit to what Matt was talking about with the flows of ETFs and how there's been a lot of discussion in the industry about ETFs being the mutual fund killers. And I think that we're going to see not only will expenses be decreasing because assets will be increasing, but I think there's also going to be pressure from the low expenses of ETFs for mutual funds to lower their expenses to compete with them. So that's kind of what I expect to see from next year. And I want to thank everyone for sticking with us through the hour. Hand it back over to you, Tom.
Great, thanks. Appreciate it. Can you click on that one more time? Thanks. Thank you, ladies and gentlemen, for joining us today for our WebEx presentation. As you know, we will have our WebEx presentation PDF and then sent off to you today. Our replay will be up tomorrow, and our next WebEx is going to be scheduled for October 9th. Same time, Tuesday, 9 o'clock Mountain Standard Time, 11 o'clock Eastern Standard Time. I do want to tell you guys also, though, that if you are part of an organization where you're looking for continuing education hours, the Investment Management Consultants Association, IMCA, has approved this for this presentation for CIMA, CIMC, and CPWA certification. So if you are part of that, I would encourage you to email me. It's at tom.roseen, R-O-S-E-E-N, at thomsonreuters.com. Now we'd like to open this up to questions. If anybody has any questions, we'd be more than happy to take on any questions you might have. So we'll give you a few minutes before we sign off. Any questions out there for us?